And we are live. I mean, Joe, we should probably give it like 2 more seconds to let everyone come in.
Yeah, 100%. A lot of people trickle in the first minute.
Yeah. Plus, this time we don't have technical difficulties to allow for that buffer.
Boom, roasted.
No one knows who I was talking about. It's fine. It's all good.
Hey, don't talk about Michael like that, okay? I'm kidding.
His background was what, on fleek? That's a term.
On
I think,
fleek.
yeah, I think that's a term. That's definitely a term. All right, we'll give it a minute more, and then we can jump into our own State of the Union.
Perfect.
Sweet. Once we see it balance off is when we should probably jump right in. Once it crosses what, 70 or 75?
Yeah, there you go.
All right, we
Why
can
not
jump
go?
right in. All right, well, obviously, hey, everyone, my name's Alex Blackwood. I'm CEO and co-founder of Mogul, and with me as always is...
You got Joey Gumtao here, COO and co-founder.
And so we appreciate everyone joining in. Obviously, we've got some big stuff planned for this webinar. I mean, some pretty massive updates, announcements, whatever it might be, teasing it out now, but let's jump into everything macro. And so I think it really helps to set the stage, so to speak, with a little bit of our own State of the Union on everything that went on this past week, this past month. And so obviously we can't go anywhere without talking about the individual State of the Union. If you were like myself, I actually kind of stayed away from watching it live. I knew exactly what I could have imagined it would be like, and I didn't really want to hear it live, with the idea being that I couldn't necessarily fact check, but I didn't want to have the facts incorrect when I was talking with you all. So much like I'm sure Joey did, we read the transcript and then we double checked everything against it. And so for us, a few of the major things that happened, obviously it was a massive propaganda fest, but there was one thing that stuck out, which was Trump had brought a Houston woman that had been outbid by 20 institutional buyers for a single family rental home, just kind of emphasizing further the affordability crisis that we have in the housing supply market. And his words were obviously pointing towards his institutional ban. Now, the next thing obviously was he brought up the USA hockey team and brought out that the goalie will be getting a Medal of Honor, right, Joey? That's correct? Yeah.
Yeah.
So definitely no propaganda there. And then afterwards, we looked at it, of course, and those are kind of the main things that I would kind of pull out of it. But two things that we want to bring up are the two bills that are in Congress. And so there are both Democrats and Republicans fighting on both sides of the aisle, so to speak, on two bills that could radically change the housing market. Number one, Trump issued an executive order whereby he said no institutional investors can invest in single family rental homes. Obviously, nothing substantive has come of that. We still have to define what an institutional investor is. Largely, people are on board that it's someone with more than 100 homes. Again, with us, we don't own any of the homes outright. Myself and Joey and also all our team members are invested in the properties, but have no worry for us offering more properties out on platform. If anything, we stand as a massive gain if in the event that an institutional investor would have to liquidate their portfolio. And then on the other side of the aisle, the Democrats are putting in place a proposal of their own whereby they are looking at potential offloading by institutional investors, and they're cutting tax exemptions to a lot of institutional investors, basically to disincentivize them from A, buying homes, but B, not liquidating within a certain period. One of the things they're floating around is a 100% transfer tax to any institutional investor that doesn't liquidate within a set period, thinking around an 18-month period there. Obviously, we'll keep tabs on it, and any of that will definitely benefit us, which will ultimately benefit you all because it will make it more of a buyer's market in the short term. Not to mention any institutional investor that were to liquidate would obviously have to come to the only one that could liquidate that amount, which would be us. And so that being said, I can't talk about this week without talking about the Citrini research report. For those of you that know exactly what it is, basically a research group put out a report in a doomsday scenario for almost an AI apocalypse. It was a 7,000 word document that tanked the markets across the board, with the Dow, the S&P 500, and NASDAQ all down substantially on the heels of the report. For those of you that read it, it basically was a self-loop, doomsday loop, whereby if you think about it, cost savings from AI boosted spending from AI companies, which boosted headcount reductions even further, which resulted in higher profits, which then fed back into the loop, whereby more and more workers and white collar jobs were rendered almost obsolete. And the idea being that all software companies ever would be fully commoditized and priced out of the market. And some of the major ones listed were DoorDash, Monday.com, I think was mentioned, as well as some other different ones here and there like Uber. Now, if you're looking at more of the AI things that are going on, NVIDIA earnings today, they obviously are the bellwether of all things AI, being the computing giant that all of this is built on. And they had revenue of 68 billion, which was up 73% from the same period a year earlier. However, stock was down more than 4% after earnings, which just again points to the fact that there is a massive amount of hype in the market, and we are looking towards a potential bubble pop. And I don't know exactly when it'll happen. To forecast that would be a fool's errand. However, one thing that did strike me pretty interesting is Claude went down the other day. And for those of you that have Claude Code or rely on it heavily, think about in 5-10 years from now when a large majority of workers were trained on AI, and imagine a world in which AI were to go down similar to AWS. Everything would come screeching to a halt because the code that they actually use to fix some of these major errors would actually go down with it. And so that's something that I'm a little terrified by. Mortgage rates, honestly, I probably can hand it off to you, Joey, in a second to talk through mortgage rates a little bit more in depth. But the other thing that's happening that we definitely want to touch on are the fact that private credit is in the news again. And this just feeds back into what we were discussing earlier on the AI doom loop. The idea being that Apollo and a lot of these other different private equity shops had turned to private credit as a great way to invest large amounts of money. And basically, they were using recurring revenue at these software companies as the stable basis to underwrite the asset. However, if you have a tremendous amount of software companies that are going to get commoditized out of the space, meaning think HubSpot. You can recreate HubSpot almost in a week with the different 5 coding tools out there. Of course, it'll have 80% of the functionality, but the idea being that a lot of these different people that are going to have to renew subscriptions over the next little bit will go back to their provider saying, give me a 30% discount or I'm going to walk and just make it at home. This is basically feeding into a private credit loop that is sure to pan out at least later this year. They're saying some emerging signs of it are happening now, whether you look at the Blue Owl Credit Fund or a number of these different private equity players in the private credit space that are starting to offload a lot of these loans immediately. So with that, I mean, Joey, if you want to go into a little bit more about everything that people should care about as real estate investors, specifically, obviously on the mortgages themselves.
Yeah, 100%. So, how does that translate to, right, what Mogul is doing, what your investments are doing in the Mogul platform? Right now, there's obviously a lot of volatility in the market. There is a massive flee towards hard assets, towards alternatives, right? Towards, like you said, the private sector, right? With private credits, pre-public offerings, non-speculative value that's based on true investments that you can, buy, grow, and sell, right? So, brick and mortar real estate, obviously the investment of choice, obviously the product that's offered on the Mogul platform. Right now, I would say the market is relatively balanced in terms of, whether it's a true buyer's market versus a seller's market. However, on the investor side, we're still very, very much in a buyer's market in terms of the cost bases we can achieve, in terms of the terms that we can negotiate, and in terms of the volume of demand that sellers are currently running into as they're trying to, get their 60, 90, 100-day plus listings off of their books. So that's creating incredible value for us. Also, there has been price softening in the market. There's been rent softening that's starting to happen, or actually has been happening and is starting to dip out, which is great because that creates opportunity for us to buy those dips and continue to operate and grow, and eventually sell at a premium to where we're buying today. So cost bases are super, super strong. Appraisals are coming in a bit above where purchase prices are right now. And then we're getting some great quotes on the rate side. So, just as a refresher for everyone, we take out all 30-year loans, and there's 10-year interest-only periods on them. The way that, loans are generally priced is they're kind of viewed as like a medium-term bond, right? So when you look at U.S. 10-year Treasury yields, everyone thinks that the mortgage rates themselves are the things reacting to the State of the Union and all of these macro events that Alex was talking about, right? But really, it's the 10-year Treasury yields that are reacting, and then the mortgage rates actually use those yields as a benchmark, because even though it's a 30-year mortgage, people typically sell like 7 to 10 years on average, right? So they actually use that as a benchmark for pricing, and there's typically a spread on top of what those 10-year Treasury yields are to come up with mortgage rates. So all that to say, mortgage rates are dipping, well, kind of in and around the 6 range and below 6 soon, which we're super excited about. We're already getting 10-year interest only loans on the 30-year total, period, term, if you will, below 6, and now in like the 5.9s, 5.8s, 5.75s, which is tremendously valuable, right? Because if the real estate itself is generating a yield post expenses anywhere above that APR, right, it's going to be extra valuable to your returns as an investor, and to your distributions on a levered cash flow basis. So yeah, all that to say, that's kind of just the refresher on how it works, and it's really favorable environment for us right now.
Yeah, and really appreciate that, Joey, on the overview. I would say, going back, I see in the chat, obviously, by all means, everyone reach out with any questions. We'll answer them throughout the course of the chat. And why we do this on dividend day, because there are definitely more questions about how things are performing, why things are performing certain ways and whatnot, both positive and also what we've got to improve upon. And I will say another thing too, on the Propaganda Fest, I meant more so on the idea that the State of the Union is obviously a major thing that happens with the president, but at the same time, my thought process was, if you're bringing out the USA hockey team in the middle of your State of the Union, then I don't necessarily have to address the full thing. But again, that's just a way to say that we'll move on to the more things that are pressing in the macro economy. And that's exactly why we were going in kind of that AI doomsday loop, as well as what Joey was outlining with the mortgage rates. It was more so just to say that we didn't have anything massive to go over there. But all that to say, let's jump into everything on the dividends. I mean, so with that, is Michael is he joining?
Yeah.
Where is he?
Michael.
Does he? There it is.
There he is, right on time.
Is his camera off?
Let me see what I can do with my camera. I just got a new camera. I thought I had a better intro other than, was Michael on? Where is he? I thought I was going to be, hey, here's Director of Real Estate for Mogul, Michael. No, nothing.
Love it.
Sweet. So, Michael, you want to give your quick background on yourself, and then jump into all things, or wait, Joey's going to take the dividend high level, and then you jump into it. But if you want to just give a quick background on yourself.
Sure. Yeah, Michael Cazales, Director of Real Estate here at Mogul. Been with the company about 1.5, almost 2 years now, and have a background in real estate, primarily on the debt side, and now kind of skew towards acquisitions. And like Joey likes to call, we're all utility players here at Mogul, wearing a bunch of hats, but mainly on the real estate supply side.
Perfect. Well, with that, Joey, do you want to kick it off with a dividend overview?
100%. Yeah. So as you guys know, we do a dividend payout on a monthly basis, right? That's one of the incredible parts about investing on the Mogul platform. 100% transparency, high touch points. We're not holding your investments for a year, aggregating everything together and then promising a payout in the future. This is real time, real performance, and you will see everything soup to nuts through every month of the year. So with that being said, some exciting stuff. We did have our first property paying out over a 3% singular month payout, which is unheard of and definitely a new high for us, which is absolutely incredible. On the flip side, we are improving on where our Airbnb payouts are on the short-term rental side. Definitely learning a ton in the process, getting a lot smarter about getting more granular with the data, making sure you guys are also looped in as the investors on what exactly occupancies and what we like to call ADRs, the average daily rates look like going forward for potential payouts in the future. So, that's the highs, that's the lows, but overall, we had some incredible property performance. We also had, 6 additional properties paying out over 1% just in 1 month alone, right? So annualized, that'd be over 12% just in yield, not even factoring in any capital appreciation, right? In the increase in value of the real estate itself. So, these are incredible opportunities to invest in cash flowing real estate. Normally, real estate's a very long-term hold. You place your money, you expect ideally you're making a high single digit, low double digit return over a 10-year period. But we have a lot of active management here, a lot of active governance rights, a lot of great decision making that we're going to be able to pass along to you guys as the investors that materially influence, the way that these properties are run and paying out. So with that, we're happy to dive in a little bit more granular, answer some of your questions, and also get into kind of the nitty gritty of how we're increasing the performance of the single family rentals on the short-term rental side, and then also continuing to take advantage of the great payouts on the pad split side as well.
Yeah, I think, Joe, if I could just add a little bit, I guess the headlines for this month on the pad split side, if you see month over month, like January was a very strong, January's payouts of December performance is very strong on pad splits. The property themselves from an occupancy standpoint and turnover was pretty unchanged from prior month. But if you would see payouts were slightly a little bit lower, and that's just the story of how pad split kind of works and can't really be viewed as a month to month thing, more of a quarter to almost annual in terms of performance. Because there's some nuance to pad split where they allow folks to make payments once every 2 weeks, once a month. Some folks are behind on payments where their January rents are actually being posted on February's numbers just due to the timing of when the transaction occurred. So all in all, very, very strong on the pad split side. And then the Airbnb side as well. Traditionally slower months. You've talked to a lot of operators that say they try to get out of these slow months just covering debt service, and really as we lean into the March early spring then into the summer where you can really make your buck operating within this business plan. So I think we're definitely poised to see that in the coming months too.
And I mean, you guys obviously have very granular oversight into the actual models themselves, as well as the rental income distributions. So I think one thing that you guys did that was incredible, especially this month, was really getting into the granular data around the short-term rentals on the go forward. And so if you look at the memos for each individual short-term rental, you'll actually see some data. And I mean, Michael, if you wanted to go over just high level, some of the things that you're seeing, especially on the recovery coming out of February and into March, especially as it relates to some of the property management, both changes and revenue optimization that we're doing on the algorithmic pricing.
Yeah, absolutely. So for the property management changes, I mean, namely the Alcaraz, we actually engaged back with the property manager who was operating it at the time we acquired it. Not to mention the performance that it was posting actually exceeds what our underwriting is. So we're excited to get the prior property manager plugged in. He is actually fully operational now and has already seen a ton of go forward bookings just within the first week that he took the reins back on the listing, which is super exciting. And then what we're also seeing on the go forward calendar, the next 30, 60, 90 days of bookings is really trending up and to the right. February bookings are ahead of what January is, and March is really when we're going to see the very strong turning the corner of peak season in a lot of these STR markets, to where right now go forward bookings for March gross earnings on some properties are 3x what January top line rents were. So it's definitely kind of in line with what we're anticipating, just weathering the storm of the seasonally slower STR months, and looking forward to how these next few months play out.
Incredible. And I think we're going to obviously hold off on questions to the end, because I will admit with some of the announcements that we're going to make later, there is going to be a tremendous amount of excitement. So I want to get some of the questions around that. Now, if we can just touch a little bit on some of the questions as it pertains to specific properties that people are throwing out, I think that would be helpful. So right off the bat, I think there were a few questions around the Yamamoto, the Gruden, and Larry, I think Larry deleted my note on it. So I think it was the Yamamoto, the Gruden, and the Shiv, as well as the Rudolph there. And so what's just any updates that you have across the board?
I'll start with Yamamoto and Gruden. Both of those, they were anticipated to close within the first week of January, whenever we went under contract originally on both of those acquisitions. As we all know, closing dates are fluid, and there's a lot of things that can delay them. Yamamoto didn't close until the first week of February, and then Gruden actually closed towards the tail end of January. So you'll be seeing first dividends posted next month. And transparently, that's on me for not updating the platform to reflect that. So we're definitely going to do a better job of getting ahead of that. And anytime closing dates do change, we'll make real-time updates to the platform just so there's no miscommunication on our end about first dividend payouts.
Perfect. And then on the Rudolph itself, and is that another case, if you want to go quickly on that?
The Rudolph.
Yeah.
Yes. So the Rudolph was a under construction pad split conversion out in Phoenix. Our deal flow partners ran into just a little bit of a construction delay, which is pushing that back, but we're actually on pace to close that probably by the end of next week.
Perfect. And then on the Shiv and the Wags, just quick 2 high-level updates on those.
Yeah, I can give the Wags. So yeah, we're pushing forward on litigation there. Just so everyone's aware, there's two workflows. One is with the title company directly, right? So we're expected a settlement that would include, obviously the repurchase value of the property itself, and then any, lost rents, debt service, all the carrying costs associated with not being able to operate the property. And so that's in a direct settlement with the title company. That's really straightforward, has been done many times in those rare scenarios where title claims happen. And then the other workflow is just working to also get restitution from the actual, I guess they're being referred to as perpetrators themselves, that started the liens that were not disclosed, right, in the previous title policies for the past 2 owners, actually, since 3 owners ago, right? And so the first workflow on the settlement talk should begin within the next 30 days, which is really great. We just got the formal update, so we'll keep everyone posted there. And then the additional restitution from the perpetrators themselves will probably take likely another 60 to 90 days, but that will be a bonus, if you will, on top of the expectation that we'll get all of our earnings back for the loss in operations. And then on the Shiv, Michael, do you want to take that one, or do you want me to hop in?
Yeah, I can touch on the Shiv. I think there's a couple things. One, we are seeing for February, March, the go-forward bookings are already exceeding what these past couple months have been. And we're also feeling the tail end of the residual effects of the prior revenue optimization manager that we had partnered with, where they had their fingerprints on the pricing, what resulted in a little bit of a detriment because ADRs were a bit lower than what we think these properties should achieve. And some of those bookings sprinkled through into January from that prior pricing model. So now February, March, April is trending a lot better than what it has been. And we're getting ADRs more in line with where we expected to perform at.
Yeah, and I will say, just to echo that, obviously everything that we're doing is to optimize the performance of these properties. Not only are we incentivized because without the performance of the properties, we wouldn't grow with you all, but on number 2, all of us are invested in each of these properties. I mentioned earlier, I'm typically the first, if not second, check-in, jockeying with Joey for the pole position, so to speak, on each of these properties. Not to mention our employees are incentivized along the way. Half our bonuses are actually paid out, or sometimes a lot of the bonus is paid out in the form of property credits to incentivize everyone joining the platform, making sure that A, the properties are performing in line with our expectations, if not better, and then B, actually understanding the process, understanding the transparency that comes with the platform itself, and making sure that it's running as smoothly as possible so that for you all, it's the best experience possible. So one last thing that I'll answer before we dive into, I believe it's the main event is next, if I'm not mistaken. There's one more question that I want to touch on because it does pertain directly to what Michael was saying earlier around if a property is delayed or what happens in between property purchase to close. And so Neil had come in with a question about the interest accruing on investor payments prior to closing. And basically the idea is what happens with the interest accruing on those reserves. Now, number one, I will say this, typically speaking, even with the payment flow as it stands today, our payment provider Plaid actually does have a holding period in and of itself. So we're not seeing interest on it for at least 10 to 20 days because there is a hold. Now the payment goes through and it's processed, but Plaid in their arrangement actually has to hold the funds on their own balance sheet for a period of 10 days for a seasoning effect. Now, in addition to it, when it is finally swept into our account, typically it's right in time for the closing. Now, if we were to receive interest on these funds, we actually can't pay out any interest because that's deemed as a security risk, meaning that paying out the interest because they're in high yield savings accounts, potentially if there is any reserves left, that actually, if we were to pay out that interest, means that we're a conduit. And in so you're investing in a securitized product in that sense. So we are staying away from securities because this is an investment club. You do have governance rights over the individual asset, which affords us the ability to offer these assets without a lot of the overhead traditionally with a brokerage shop, as well as the traditional, I guess, asset management fees along the way. So that's why we're able to charge lower. Anything you guys? Yeah.
Yeah, I was going to add too, like, just, we don't typically broadcast this, but the alignment of interest could not be stronger, to be honest. Like, as with the investment club structure, like none of you as the investors actually have to provide like the recourse or guarantees on any of the debt, for example, on the properties, right? Like you are gaining the benefit of working with a fully vertically integrated real estate platform and still having the full governance rights over the property. So that's honestly the first of its kind that's ever been done, and we're really, really proud to be able to boast that. In terms of alignment of interest, like we're the ones actually sourcing the leverage and actually putting up the recourse, right? So yeah, in terms of, you know, consumer protection, if you will, investor protection, it could not be a better alignment of interest. And to Alex's point, like we're definitely fully invested, you know, both from an equity perspective and also you know, from a mechanism perspective and legally in the properties as well. And then yeah, I don't know if you wanted me to touch quickly, Alex, on like a lot of people have been asking to highlight difference between pad split and Airbnb and what the benefits are of each.
Yeah.
Before we hop into the next segment. But yeah, just quickly, you know, high level, right? It's two different operating models. So you know, Airbnb versus pad split, I would chalk it up to, you know, which one has better cash flow and which one has better capital appreciation in the future, right? And so Airbnbs, you're ideally targeting relatively a little bit lower cash flows and from what you would see from a higher yielding asset like a pad split, where you're achieving, you know, 10 to 12% plus, right? Even in year one operations. You know, Airbnbs are typically targeting 6 to 8% year one yields, and that will continue to grow through the business plan of the asset, through the hold. But your capital appreciation from a conceptual standpoint is higher, right? So you're actually buying, growing, and selling eventually a premium business that you're creating value in, right? By operating and growing. Not unlike a hotel, if you will, right? Like a hospitality asset at the single family rental level. It's the closest thing that we have in SFRs to hospitality. And then on the pad split side, that's where you're targeting, again, more of that yield play, right? 10 to 12%. But the capital markets are not as familiar with this asset. It's super, super new. So although there are really great premiums on the yield side, you can't necessarily bank on the fact that, you know, inflationary 3% per year in capital appreciation will play out. You know, sometimes you might see 2%. Sometimes you might see 2.5%, but on the flip side, you're getting, you know, 12% annualized year one yields. So it's really just about differentiation and what, you know, diversification, right? It's your appetite for what you're aiming for. Are you more of a yield investor? Are you more of a capital appreciation investor? And that's a pretty good segue into the next segment, because there's actually more options than just the two, and there will continue to be more options than just the two. But yeah, with that, I can pass it back.
Yeah, I mean, so who's kicking it off? Who's doing the grand reveal?
We doing it? We doing it? I can share my screen.
Saul said more
Alrighty.
options.
Does anyone want to guess in the chat what the new asset is?
What type, right? Yeah.
What type? Yeah.
It is single family.
That's it. Oh, Motel 6 there.
Motel 6.
Gregory got it.
Gregory. Okay.
Gregory.
No, it looks
Yeah.
Gregory. There we go. So without further ado, Mogul's first ever long-term rental, the Buffett. Yeah, so this is a quadplex out of Cape Coral, Florida, that is in the Cape Coral, Fort Myers.
Can you zoom in a little bit, Mike?
Yeah.
Definitely want to give them an opportunity to see it. And then obviously it is in the chat for anyone to go ahead and
Is that good?
peak investment. That is a handsome asset. Yes.
Handsome.
Beautiful.
Yeah.
Beautiful.
Handsome. Yeah, so this is a quadplex. It is comprised of 8 beds, 8 baths, and it's 4 units. And yeah, located in Cape Coral, first ever LTR. And we have this, I'll step down on the underwriting of this 81K year one rents, which is over $3,000 lower than what T12 actuals are. How we underwrite this is conservative on what tax reassessments will be, homeowners insurance. Miscellaneous cost is relatively light, and that is because with a lot of LTRs, utilities are primarily tenant paid. And then that's the case on this one as well. The only owner paid monthly OPEX items are the trash and lawn care and pest control, which realistically will not net out to be 550. It'll be a good bit below that. But again, we're always conservative in our underwriting where possible. And I'm really excited about this. Not only is it a consistent cash flowing yield play, average tenancy of the 8 tenants in the property now is over 5 years. And a lot of major CapEx items have been taken care of within the past 5 years, namely roof, HVAC, and also hurricane rated shutters have been installed in the past 12 months as well. So a lot to like about this, not only with its stabilized, consistent cash flow, but also a lot of the major items that you kind of worry about as an investor of what you're going to have to come out of pocket for in the near term or over any point over the whole term. A lot of those items have been addressed by the current seller.
Yeah, super, super well said. Honestly, we could not be more excited to dive into the LTR space. As Michael said, not only is it a lot more manageable from a vertical integration standpoint and working with the property managers and furnishings and turnover, but also it's just an incredible value proposition, right? It's different, right? Completely different from the STRs and the MTRs that we discussed. This is LTRs, in my opinion, are kind of the closest thing that you can get to like a bond in real estate. Like really, it's just a very clean, easy, stable kind of, relatively sometimes lower returning compared to the higher risk stuff that you could do. But, again, stable cash flow, stable tenancy, 5 years plus, proven business plans, and really good cost bases. I mean, right now, to be honest, LTRs, we're coming out of a dip for pricing. And Michael, maybe it'd be helpful for you to talk through a little bit of the background of how this one came back to us on the pricing side and some of the significance of that, because it really, really speaks to the opportunity that the market's presenting now.
Mm-hmm.
Rates, again, coming down below, 6% in some cases, yields still tracking relatively strong because it's still much, much cheaper to rent than it is to own, even as rates continue to come down, and that won't change for a very long time. And so, especially as you amortize, closing costs, et cetera, all the things associated with owning, and that's outside of assumptions around, maintenance and, reserves that you need to hold and all of these different things that are associated with it. So rents are still very much, up and to the right, it's wobbly in terms of how they increase, but LTRs just present an incredible value proposition, an incredible third option to business plans that are typically available in the SFR space, and just a testament to the team and kind of what we're diving into now in terms of more optionality and more kind of opportunity across the risk spectrum and across business plans as well.
Yeah, absolutely. Good.
Real quick, and then if anyone wants to invest, obviously ahead of us sending it out to the public tomorrow, there is the link in the chat to the Buffett. And definitely feel free to shoot over any questions that you might have in the chat about this asset in particular. But Michael, did I cut you off? There was something else you're going to cover real quick?
Yeah, well, I was going to cover what Joey asked on the front end for me to talk about is how we had eyes on this asset and then it came back to us. So we've had, for a lack of a more sophisticated term, feelers out for LTRs in multiple markets across the country for months now. Without sacrificing quality, we wanted to wait till we found one that meets our requirements on quality and performance before bringing something online. This one fits that bill. We saw it a couple months ago where it was part of a greater portfolio that was selling for $4 million. That portfolio recently came down with a reduction to $3.5 million. And that is when we were able to take a look, and with updated pricing, not only being more in line with underwriting, but pricing from a very motivated seller that is actually posting at what we believe is below market value. We're still holding out. We'll probably get the appraisal back on this next week, But from what we see from comps that are almost identical down to the year build, even 100, 200 square feet lower than this, smaller than this property, are a couple tens of thousands greater on purchase price within the past 12 months of a sale compared to where we're getting this asset at now. So all that to say, we jumped on a good price correction of a greater portfolio that this came from, and didn't want to sacrifice any type of quality to bring it online any sooner than we did.
Definitely. And that's tens of thousands per door, by the way, right? This is a 4-unit multifamily, if you will, LTR. So yeah, incredible value proposition.
I mean, obviously, feel free to leave any questions in the chat. We're more than happy to get to it. Obviously, our focus right now is on this asset. So there are a few questions right off the bat. Who is the property? Oh, and also did want to mention this property did come in through an investor in the platform. And so thank you for sending it over. If you do have any assets that you're potentially interested in sending our way that you think that we might be interested in, here's a great example of the fact that we do action on some of these assets. It definitely pays the quote unquote network effects, as Joey and I were discussing earlier this week. And so some of the questions right off the bat, unless Joey, you were going to go into anything else before we jump into questions.
No, go for it. That's great.
I mean, who is the property manager for this?
Yeah, so this property was self-managed by the prior owner. We've already engaged with multiple property owners, boots on the ground in the Cape Coral market, and are finalizing kind of interviews and evaluations before picking one to go forward with.
Perfect. Well, that's good. Yeah, and I will say that that's part of the beauty and part of the cons of the single family rental market. A lot of market data you can't necessarily trust because a lot of leases happen off market, which makes this a pretty attractive one to us. Is the idea on the go forward, we will get to price it out and hopefully achieve yields even greater than what we had underwritten. So, I mean, we keep getting investment. If you want to refresh maybe to see what we're at now, and good to know that members of Mogul platform can send properties. So that is good to know. 32. Nice. Well, that is good stuff. First few minutes here live. And did the investment page displayed say short-term rental for this property? It should say long-term rental, right? That's anyway.
It's LTR.
Yeah, LTR. Typical age of the rental individuals and LTRs in the future properties, and specifically for the Buffett. Is it? Yeah, Buffett. Yeah. Also, by the way, Jimmy Buffett, not Warren.
Yeah.
That was a that was a massive point of contention. Everyone immediately thought Warren because of Mogul, etc. But this is named after Jimmy Buffett, as our Delray buddy Larry likes to chime in with. So, Michael, what do you want to answer?
While we get super granular on a lot of our DD, the age of the current tenants was not part of what we did thus far. We do have all leases in hand, but right at this point can't necessarily answer the average age of the individuals that are dwelling it currently.
Yeah, we can't disclose that publicly. I would say typically, with LTRs, I mean, it varies, right, in terms of like the is also called the ICP, the market that we're targeting in terms of the tenants that we're looking at. I would say the tenant profiles for LTRs are probably the most variable, right? With MTRs, we've talked about specifics around kind of like what's been typical, what we've looked at in terms of the traveling professional who is doing a shorter term stay in a city, 3, 4 months, 6 months at a time. Obviously, the LTRs are more stable, so they're again 5+ year tenancy. So you're looking at people that are kind of embedded in the market, right? They live there, they work there. This is their home, and this is in some cases with LTRs it could be a forever home, right? If you're talking about 5 years plus. So that's kind of the tenancy profile. Is it's a little bit more of like that stable, grounded individual that lives in the market, or family that lives in the market, and doesn't have to travel around as much.
Perfect. I think if you want to refresh, I think we got another one in. There we go. Nice. In the first few minutes here, this is what we can expect, especially with the first long-term rental on platform. Again, it really speaks to that blue chip offering. Joey has been salivating at the mouth to get one of these things on here. every week it seems like we were talking about when the what would you say, like what's like the water, anyway, the dam's gonna break, I guess, is the talking. It's late. I'm an early riser. Joey's a late bird. Anyway, I like the long-term rental multifamily. Again, definitely feel free to invest now early before we launch tomorrow. We expect this one to sell out pretty quickly. Brad asked an interesting question. Does that mean you have others under the $3.5 million portfolio?
That is an interesting question, Brad.
That is a intriguing question, nonetheless. I guess see, who knows? Maybe you, maybe.
I wonder. I wonder.
There's more multifamily to come, regardless of where it's coming from.
Yeah.
Right.
If you want to refresh again, I think we got another few bones in the property there. Boom. Nice. I'm all in on multifamily. People are saying, oh, here's one that's pretty interesting. How did the location Hurricane Alley factor into the decision to acquire this asset?
Yeah. So we got a lot of material from the seller, a lot of that being elevation certificates on this property, flood disclosures. The seller has owned this property for 15 years. Never once did they have an insurance event, and because of a storm or a triggerable event for the hurricane deductible to come into place, nor did any flood events happen either. So that gave us comfort on the area, not to mention just the greater MSA is seeing a softening right now, turning into a buyer's market. It really hit a peak, post-COVID peak in terms of pricing. And from like 2022, 2023, we've seen a step down on not only pricing, but also rental rates, which on the surface might cause pause for some people, but we view it as a very good time to step in, the more of a bottoming out of the market on both the price and rental value side as well.
And if you're fresh, I think we got some more investment in there. We should do it where it's like a live tracker in real time.
Dang.
It's fine.
Is this the most ever on a webinar, Alex?
Most so far. I'm assuming we're going to pass 100 for sure. There's no way. I don't think there's a way that we don't. I mean, this is a beautiful asset. I invested in it. And also, if you're tracking in the chat, I think we're actually above 100. There we go.
Yeah.
Refresh it one more time. If you're tracking the chat, Joey has not been paying attention because he is answering everyone's questions, it looks like. So that is bad. This is what happened. He is a famous YouTuber on the side, and so he knows how to respond to comments in the chat pretty well. And they are pretty good answers. I'm not gonna lie, I'm reading them as we speak. When I invest in property, there's a $3.99 processing fee if I want to invest in multiple properties simultaneously. Is there any way to lump together the entire investment funds and only incur that processing fee once? Honestly, not a problem until now, which is great. It's a problem with growth, and the idea being that we have a tremendous amount of assets available at any given time. So a basket buy is definitely on the horizon. I mean, Aton, if you want to make note of that, that's something I completely agree with. It's the idea about the transaction. Unfortunately, we're actually eating a majority of the transaction fee. This is just to make sure that we aren't completely underwater by transaction fees. All that to say, I think that's something that we can add to. A lot of positivity around it. I'm trying to pull in which questions Joey isn't.
Sorry, not trying to create confusion. There's so many questions coming in. I want to make sure everyone gets the answers.
By the way, we also have a question doc that's going in live time. Thank you, Larry, for this. That's our Delray buddy, Larry, and is he from Delray? I think he's Delray. Anyway, are you looking for 2-year lease periods?
Larry. Yeah, so I think I did answer that one. Typically, it's a 1-year minimum, but 2-year lease periods can be offered for a slight monthly discount just to give us better occupancy guarantees up front. So that's definitely something that we work with our property managers on for sure. Just like if you're in an apartment complex, sometimes they'll offer you 13, 14, 16, 18-month leases for a slight discount, right, monthly versus just the 12-month. It's because you're guaranteeing them more occupancy, more guaranteed cash flow over a longer period of time. So they'll take a discount for that.
Perfect. Well, and also there is a question about, are these properties listed right now? I mean, Larry, do you want to just send back into the chat the URL just to make sure that everyone has it. They are listed by that link if you click into it. And then when it becomes available publicly tomorrow, you'll be able to see it as part of the main property page. This is the benefit of coming to the webinar. All right, I just want to make sure that, okay, Joey did answer that question. Damn it, Joey. Where can we send investment properties or your review to see if it fits for the Mogul platform? In Larry, do you want to take that, or John? Someone will throw their email in there, right? Is that good, Larry? If you want to throw in, or Sawyer, I guess. Someone's fighting to throw their email in the chat, so definitely feel free. lcummings@mogul.club, and there it is. Just got the order. Can you touch on how same properties will result in new K1s? Really quickly, 2 seconds on that. The reinvestment works, think of it as almost like a waterfall mechanism, whereby if an asset is still available, it'll check, and if it is not, if it is available, it'll invest in it. It doesn't matter if it's $250 or less, it will reinvest in that asset. If it is not available, it'll look to the remaining assets in your portfolio and split out amongst the different assets in your portfolio. If you have no available assets in your portfolio, it will sit within your individual investment account until you decide what to do with it, whether invest or basically pull it out. Same properties will result in a new K1. Again, that it depends again on that waterfall mechanism, and then K1's one per asset is the way it would work. I'm a cash flow investor. Pad splits and long-term rental seem to be the best bet for cash flow. Are you looking in the Midwest for multifamily long-term rentals? Population is lower in the Midwest, but it looks like you can cash flow there.
Yeah. So I don't know. Yeah, you go ahead, Michael.
No, I was gonna say we're looking all over, especially on the major metros where there's a thesis to be had on the macro level. It is, to begin with, it's hard to find cash. It's not hard to find a cash flowing LTR. It's hard to find one that's cash flowing well enough to be on our site and to meet the required investment returns that we seek. Could we post one on here that has a 4% average yield over the hold term? Like, we could find those in probably any market across the country. It's just we want to look for the most accretive plays that are out there. And yes, we do have eyes on the Midwest, but just haven't found the right one just yet.
Yeah, definitely. We have feelers out there in some incredible markets, Cleveland, others that we're looking at with what seem to be pretty solid opportunities. But again, to Michael's point, we're not going to sacrifice on quality. We want to make sure we're bringing the best only to the platform. So
there was an earlier question about the Dolly. It's a timely question because I got the text from our mortgage broker like 2 hours ago that we're cleared to close for tomorrow. So yes, that is closing on time.
Oh yeah, that means we're heading to Dollywood for our next company retreat, which is pretty. If you want to refresh it real quick, I think we got another few in there.
Boom.
Nice. Wow, that's awesome. Super exciting to see.
And then any plans to create a similar crowdfunded debt fund? I mean, that could be something on the horizon. Our goal is to expand beyond into the entire cap stack of real estate. So we'd love to go into the debt side now. Again, would have to make sense structurally. We would want to put in place guardrails to make sure that it's accretive. And yeah, I mean, that's on that front. Is there anything else that you saw in there, Michael, in the chat that you wanted to touch on real quick?
When I was scrolling through, the Dolly question was the one that caught my eye. I'll do a scroll further to the top to see if there's anything we missed.
Perfect. Yeah, I have the questions going on in the background too. And
then, there were questions on minimums, right? Minimum investment. There were 3 questions. So what's the minimum to withdraw dividends? What's the minimum for international investors? And then what is the reinvest minimum for, like reinvesting your dividends was the other one. So yeah, you want me to just take those 3 really quick?
Yeah, I mean, at the reinvestment dividends, I don't know if that necessarily makes sense, given we just went through the whole reinvestment strategy.
Yes, and the current minimums in place are really just to make sure that costs associated for us, so that we don't put on the investors, are there. That way, again, we're not wasting your time. We're not wasting our time in terms of the ability to facilitate those investments at, again, a cost, above where the investment itself is being placed. So that's why the minimum exists, like the minimums for international investors, right? For example, which is currently 50K, correct?
I believe it's 50 or 100. I mean, if anyone is an international investor, feel free to reach out to that L. Cummings email. I definitely think that we can discuss with you exact methods there. But yeah, if that helps.
Yeah, feel free to reach out to Larry directly, because we definitely want to make sure everyone has the opportunity.
And then is there a way to get a single tax form instead of getting multiple K1s with each investment? It might get difficult to manage taxes and fees for each K1 to file in ITR.
LTR, I think, is what they're referring to. No?
I don't know.
No, I think is that an acronym?
I don't know.
Is it?
I don't know.
I feel like I'm about to get got. He's gonna say,
Yeah. Are you getting
There we
D's?
go. There we go. I was like, jeez. So the setup is each K1 for each print individual property company LLC. We're set up as Delaware company LLCs, so hopefully you'll only have to file within the state of Delaware or the LLC for the K1. However, we handle a majority of any like the accounting problems there. And then outside of that, to get an individual K1 will require you to invest in the fund itself. And so we do have a fund for accredited investors. So if you are marked as a accredited investor, then of course reach out to us and we're more than happy to enable that for you. And then when the Gruden first payment arrives, will be closer to 2 months now, since it closed at the end of January. Michael, do you want to quickly go through that?
Yeah, I can cover that. So it's going to be the first full month of operations is going to be February, which gets paid out in March. So it's going to be 1 month's worth of operations, because we always pay from the prior month's performance. Being that it did close at the tail end of January, I'll have to recheck the calendar of what bookings that we were able to capture under our ownership at the tail end of January. So it could have 1 or 2 bookings tacked on to what February's bookings will be, but it will be just one month's worth in the grand scheme of things.
And then if you refresh, I think we got a few more investments there, which is pretty cool. Cool stuff there. Well, okay.
Wow.
186K remaining.
Dang.
And I did get actually a question over text, which is the first time during a webinar I got a question over text on how much is the max that you could invest in it. There is only 100. I mean, if you refresh again, I think it's even less. There is only like 181K remaining. So maximum would be that amount as it continues to drop down. But I will say that it will definitely move pretty quick there. And then is the fund for current investors only covered on the website? Yes, Larry will reach out to you, Neil. And again, definitely feel free to throw your questions in the chat. We have been taking note of them. And if we don't get to them now, we're actually going to email you with it after. Oh, geez. If you refresh again.
Yeah, I saw that. Yeah.
If you notice why the phone's buzzing off the hook, 157K remaining. All right, that's good. Definitely the greatest and worst Slack channel to exist, because it has me constantly checking my phone. And then Larry, if you want to reach out to Basim as well. Are there other questions? Oh, the lending market. Would there be a lending market to lend against your properties on the Mogul platform? I mean, Joey was the one to first introduce to me the concept of lending against your equities in the Bank of America scheme, so to speak, as he where you got, what was it, like 90% of dollar on net asset value of the S&P 500? Wasn't that it?
Yeah, that's exactly right. Pretty sweet.
And you got to like leverage against it to basically put a down payment on a home. So yes, I mean, long story short, real estate is a stable asset. It's an income producing asset, unlike a software company where the ARR could potentially go down overnight as it gets commoditized. People are going to continue to rent out properties even in the post AI apocalypse. So the idea being that we can potentially facilitate that would be in the future, of course. The idea being that we would work with a lending partner, a bank, a private lender, to basically come up with a loan against the equity you have. So that way you can almost do a margin trade, so to speak, investing on the properties. Again, I think it speaks to the secondary exchange. Our goal is by end of year to have that up. And the idea being that it's fully liquid, Secondary, with a market maker in place, a line of credit would almost facilitate that instant liquidity, getting rid of any speculative bid-ask spread, and the idea being that you could have a full market infrastructure in place. So using it to market make, fully liquid, and then you move into different financial products on top of it. What is the minimum investment dollar amount? $250 into the properties, and then it's $200K into the fund. Can we turn this into a pad split in the future if needed? That's actually
let me take that, Alex. To answer your question, yes, obviously would be put to a vote of all owners in the LLC that owns the property, and it also depends on, I think where it stands right now, Cape Coral isn't listed as a core market for pad split, meaning there's not as much of a presence, not as much company paid marketing on the pad split side around driving tenants into pad split dwellings. But we are actively looking for kind of smaller multi-family assets that are fit into a pad split, and there might just be a triplex in Florida that we are circling very soon on the horizon.
Whoa, that's a big reveal.
Yeah,
right.
It gets a little bit later, and things are loosely ships.
I have a 3-week-old. I've been running on 5 hours of sleep for the past 3 weeks, so I'm just.
Yeah, the other day in the all hands, when you were like, "Give me a sec, I need to get coffee," as you had just taken down an entire coffee on the all hands. That's about right.
There's not enough coffee in the world right now.
Yeah, I'm actually on a no coffee grind. I'm trying to do anyway.
Good luck.
Yeah, it's not good. The dividend withdrawal is under the minimum. Please reach out to Eitan or Larry if you can connect with Justin on that to discuss about withdrawals there. Can we set up a co-owner in case of death? We do have beneficiaries. We've been adding tremendous amount of products in the background, mind you, that are more efficient. So you can add beneficiaries, look at your account list. Larry, how to add beneficiary. Larry, if you want to send in just a link to it. But yeah, Eitan and Ryan have been absolutely crushing it on new feature updates as they come in. So by all means, shoot them over to us, and we definitely can continue to do that. And so, geez, we might sell it out before tomorrow.
Might sell it out tonight.
Going it on a webinar is definitely that would be an incredible milestone.
How long does an asset O'Hara languish on the site before it is canceled or funded internally? So we're actually out of balance sheet exposure range. I mean, like, is on the O'Hara, we're still set to close on pace for that, correct? Yeah.
Yeah. We don't have to fully sell out the asset on platform to close on the asset.
Yeah. So we're fully out of balance. Like, first of all, we set in the purchase agreement. It's not like it's a flexible purchase agreement. The idea being that we set in place the closing date, the day that we set in place the purchase agreement. Obviously, things happen that might push it back or actually accelerate the process. However, our idea is we adhere to it unless worst case scenario happens along it. And the idea being that us at Mogul will actually true up it using balance sheet exposure to actually close on the asset in real time and continue to sell it on platform. Now, for that one, we actually don't have to sell out the entire asset to get there. I was hoping you'd answer Justin's dividend withdrawal question here. Yeah, I mean, it really comes down to the fact that there's a withdrawal fee, obviously, that it happens with our payment processor. So the idea being that if you would like to withdraw, there is kind of a minimum that we have to put in place. I think it's only $10 is the minimum, if I'm not mistaken. Anyway, if you would like to discuss how to get around that, by all means, reach out to Larry. He put his email in there as well. We'll reach out to you, Eitan, and our team can reach out there. Now, does Mogul plan to hold long-term rentals for 5 to 7 years or more? Either of you?
So we underwrite all of our properties typically on a base case 10-year hold. You can play around with the underwriting for 5 to 7 years. The beautiful part about the secondary market is the asset can continue to live on the Mogul platform, continue to appreciate every year, continue to operate with positive cash flow every year. And we don't actually have to sell it in the real world for you to achieve your return, right? So, that's a long-winded answer to your short question. Is typically 10-year hold, but you can liquidate at any time according to the secondary exchange that will be delivered, likely going into next year.
Yeah.
Yeah, and I think it's important to call out also Mogul never unilaterally makes a decision to sell these assets. You, as the owners, hold governance rights over any major property decision. We would give our 2 cents on what we think would be a good move in terms of where the market is and capitalizing on value appreciation and whatnot, but it is always down to the investors and a vote on major property decisions.
Great. And I will say we're at time. Really quickly, do want to run a quick survey by you. Would you prefer to have more webinars in a month or one longer webinar? Very curious if you could just throw that in the chat. And because I will say we'd love to get to everyone's questions. We're going to do our best to reach out to you all over email if you have questions that weren't answered. But yeah, definitely reach out. One longer, one per month, one longer. Okay. Well, I mean, that kind of answers that. That is tremendously helpful because we were going to go 2 webinars. So this makes a tremendous amount of sense. So do appreciate your time. Thank you so much. Any closing words from Joey, Michael?
No, really appreciate everyone. Yeah, thanks so much. And huge shout out to the entire team for making this happen. Really exciting.
Perfect. Well, thank you, everyone. Most successful webinar ever, biggest webinar ever. Almost sold out of a long-term rental before you even launch it tomorrow morning. So do appreciate everyone's time. Michael, did you have anything? I didn't mean to cut you off there.
No. Thank you, everyone, for joining. Appreciate the interest in this LTR. And if only we had a couple more to offer out to you guys, that'd be great.
Perfect.
If only.
Well, we will send around the webinar recording. It'll be on our YouTube channel. But thank you again for joining. I mean, Joey, do you want to end the event or I can end the event?
Yeah, I will end it now. Thank you so much, everyone. Really appreciate you all.
Thanks, everyone.
Hit refresh one last time.
One last time, quick.
That we got told to do that. I don't know if it's all right. 136K. Nice.
Nice. All right. Thanks so much, everyone. Appreciate it.